Hi guys, welcome to my channel. This is your girl Megan with Fit Financial Planning, working out your own financial plan one lesson at a time. Thank you so much for joining me and happy 2025. Here's to a prosperous year and wishing you all the best for the year ahead. Well, it is the tax year end, which is the big buzzword right now. So I just wanted to highlight two things that are happening within the financial planning space at the moment. So we are engaging a lot with our clients regarding their top-ups, whether it's to their retirement annuities or their tax-free savings accounts. So that is what is keeping us busy at the moment. But just remember, before I continue, that none of my videos constitute financial advice. My videos are educational and they just highlight, the different investment products and what is happening in the financial planning space as a whole. So if you do need financial advice, please speak to an accredited representative or wealth manager. And they should be phase compliant and licensed. All right. The only way you can find out if someone is licensed is to go on the FSCA website, ask them for their license number, and when you enter it there, you should see all the reps under supervision. Well, all the reps that are listed under the institution, whether or not they are on supervision, you'll be able to see that as well. So it's your responsibility to make sure that you're speaking to the right person. Well, let's get into the two investments and how you can maximize your savings as well as from an investment point of view and from a tax perspective. Firstly would be your retirement annuity. So we know a retirement annuity is a private pension. It works exactly as a pension that you would have through your corporate, but the contributions that are done towards or made towards a retirement annuity are used using discretionary money, which is tax-free money, right? So you received your salary and you were taxed and you took that after-tax money and contributed towards a pension. Now what the government does, it says, okay, because you have contributed towards a pension using after-tax money, we will give you that money back when you submit your returns at the end of the year. So we know that during the month of October, that is when the portal is open for us to actually submit our returns at the end of the year. Then what happens is you will get a tax certificate that shows all the contributions you've made towards your retirement annuity, right? So it's actually called a contribution certificate. I have made a video, I think a video or two, my previous videos. If you could just search tax certificates and contribution certificates, there I explain the different type of tax certificates and what they are. So you will receive this tax certificate in the middle of the year, around about May, June. The different institutions will email you the certificate, and then what you do is you upload it, you answer all the relevant questions and you upload it on your e-filing when you're doing your tax returns. Then SARS will then do their own calculation to say, okay, this is how much we are going to give you back, which effectively reduces your tax liability. All right. Remember, when you're contributing towards a pension through your corporate, they're using pre-tax money to actually invest that money for you. So if you're earning 10,000, 1,000 goes to your pension fund and you're only taxed on 9,000. Okay, so that is why when you do retire, that is when the tax triggers. Okay, because they've given you an opportunity to invest and save pre-tax money. So when you're contributing towards your retirement annuity using post-tax money, that's why when you submit your certificates and your contribution certificates, then SARS will pay your money back. All right, they do a specific calculation and they check what amount you earned in that tax year by looking at your RP5, and then they'll check what is the percentage of that you've contributed towards your RA, and then they'll effectively work out how much tax you are going to get back. There is a formula and a calculation that they use. All right. So during this time, you'll find a lot of clients wanting to actually maximize their contributions towards retirement annuities. So you'll find that they're contributing towards their pension at work, Maybe they're contributing at a rate of 20% or 15% or whatever the case may be. And then with their retirement annuity, they're contributing a specific debit order amount, but they want to actually maximize this 27.5%. Okay, what is this 27.5%? Well, this is the parameter that legislation has given individuals to contribute towards their pension fund, which will then result in them getting that tax break. Okay, if you over contribute, you won't get the tax break on the over contribution. You will only get your tax break up until 27.5% of your pensionable salary. All right. So if you're self-employed, then the threshold there is 350,000 Rand of your total income. So the income that you're earning, you can contribute 350,000 Rand of that income per year towards a retirement annuity. Then SARS will then give you some of that money back as a tax return. Okay. So there are two options. First would be 27.5% of your pensionable salary, or 350,000 Rand per annum of your total income. So this could be your business income, your rental income, any other income that you're receiving. The total of that the maximum that you can contribute towards a retirement annuity is 350,000 Rand per annum. Okay, so I hope that makes sense and you understand the differences between the percentage and the Rand value. Okay, so a lot of people then want to maximize those contributions within this tax year. So this tax year is tax year ending 2025, right? So this is what is keeping us busy at the moment, where people want to know how much more can I contribute, because I have some discretionary money, but I want to add that money into my retirement annuity. Or some people have other investments which are flexible investments, discretionary investments, where they actually want to reduce their discretionary money and add that to their retirement money. The benefit of doing that is your retirement money is exempt from your estate. So for estate purposes, if you don't want to inflate the size of your estate, then you would contribute and grow your retirement fund, because retirement monies are exempt from your estate. Monies that are invested in a normal investment, those do form part of your estate. So when you pass away, if your estate is 3.5 million Rand and more, then you will pay estate duty. But if it's less than 3.5 million, then there will be no estate duty payable. And estate duty is payable at 20% of the size of the estate. Okay, so a retirement product or retirement annuity can be used as a tool for estate planning as well, right? So that's why you find your wealthy individuals will have retirement annuities over and above their pension, so that they can actually ring fence all their wealth within the retirement annuity structure, right? And we know that once that happens, that money becomes compulsory money and not discretionary, meaning that that money is forced to then, when they retire, to annuitize that money, and it pays them a certain income, in retirement once they've formally stopped working. Okay, and then obviously the beneficiaries or the second life assured would be a spouse. They would continue with that income even when the first life assured passes away. And then should the second life assured pass away, the beneficiaries continue with that income. So you see how that income is actually ring fenced, and it's sort of aligned or earmarked for a specific line of people, and it doesn't necessarily form part of the estate. And also retirement monies are protected from creditors as well. All right, so that is the benefit of having retirement money. So that's why a lot of people would like to pump whatever discretionary money they have into retirement annuities. Okay, so that's the first one. The second one would be a tax-free savings account. So a tax-free savings account is a flexible investment. All right, there you're using discretionary money. So on this one, you don't get a tax break, but the benefit of this one is that whatever growth you have on that investment, it's tax-free. There's no capital gains tax, there's no tax on interest, and there's no dividend withholding tax. Okay, so on that end, you are, growing that investment and knowing that all the growth on that investment is tax-free. Okay, so the tax-free savings account has specific limitations to it. Okay, so the first limitation is that you can only contribute a certain amount in a tax year. Okay, remember, a tax year runs from 1 March to February, 28th of February the following year. Okay, so currently the tax year is tax year ending 2025. Okay, so within this tax year, you can still contribute towards your tax-free savings account or start a tax-free savings account, but the maximum you can contribute is 3,000 Rand a month, which then translates to 36,000 Rand per year. That is the maximum you can contribute towards a tax-free savings account. Okay, so a lot of people would want to maximize on that for this tax year end. Then come 1 March 2025, they have an opportunity then to also maximize the contributions towards the tax-free savings account at 36,000 Rand per annum. You're not forced to contribute 36,000 Rand per annum. You can contribute as much as you want or as much as you can afford. Not as much as you want, but as much as you can afford to. Okay, but capped at 36,000 Rand per annum. So these are the two opportunities where you would most likely want to top up either your tax-free savings account or top up your retirement savings account. Okay, so if you want to know how much would you still need to contribute towards your RA to maximize those contributions, then you'd need to speak to your financial advisor who will do the calculation for you. Tax-free savings account, self-explanatory. You know that if you're contributing 1,500 Rand a month, then you know that you still have, leg room there. You still have to top up at a specific amount to get to 36,000 Rand. Okay. Usually, if you have a tax-free savings account, they'll show you how much you can still contribute for that tax year. Okay, once you've reached that threshold, then you can't contribute anymore. It blocks you. Okay, so that's how a tax-free savings account works. Then all the growth on that is tax-free. Okay, unlike a normal unit trust where you can, invest as much as you want, but whenever you do take the money as a withdrawal, that will trigger a capital gain event, or that will trigger an interest tax event. Okay, where you will pay capital gains tax and you will pay interest tax. So just note that if you're investing in a normal unit trust and any growth on that will be taxed, okay, versus a tax-free savings account where the growth on that is not taxed at all. Okay, so that is how those are the main differences between a normal investment and a tax-free savings account, although they are both flexible investments. So those are the main things that you need to look out for now in February, and that's the buzzword you'll hear in the industry. But the third thing I want to highlight is that for your two-pot withdrawal, that remember you are allowed to withdraw once in a tax year. So if you have taken that opportunity to withdraw in, let's say, last year, or you've withdrawn now, then you've exercised that once withdrawal within the tax year. Come 1 March 2025, you will be able to withdraw again from your savings component. Okay, and then you'll have to wait again up until 1 March 2026. Then you'll be able to withdraw again. Okay, so just remember that in the tax year, there are 3 things that you can look out for: is your withdrawal window from your savings pot, from your retirement savings, and then it's your top-ups, your top-ups towards your tax-free savings account and your retirement annuity. Okay, again, if you need to speak to a financial advisor, please contact someone, or if you'd like me to refer someone to you, please just pin in the comments below or send me a DM and I'll hook you up with someone who is accredited and who'll be able to give you the necessary advice you require. All right. Guys, thank you so much for your time. And yes, again, happy 2025. Hope this year will be a better year for you and for me. As my previous video, you guys have seen that 2023 and 2024 were very hectic years for me, but we are back and we're thriving and we're ready to take on 2025, and it's going to be a good year for all of us. Okay, take care and God bless, and I'll catch you on the next one. Bye.